What's one move in bed that makes a man go crazy every time?
Oh, you gotta give him that Hawk Tuah and spit on that thing. You get me?
So that right there is Haley Welch, also known as the Hawk Tuah girl, who became famous after she gave a viral street interview where she talked about, and I'm trying to think of a way to say this that will be kosher with YouTube, but we'll just say, making a gentleman happy in an intimate scenario. Now, of course, she ended up parlaying that fame into a bunch of celebrity appearances, a podcast, throwing out the first pitch at a baseball game, and a bunch of other different various things that happened to be very atypical for somebody who had a viral moment, being able to stretch that out into so much fame. However, unfortunately for Haley Welch, although not all that unfortunately based on how much money she made off of this, she also decided to run into a crypto scheme, getting people to buy into her coin. And before you guys say everybody should have known crypto coins are a scam like that, the fact of the matter is it looks like she lured a bunch of her fans who were not used to the crypto market, and they ultimately ended up getting ripped off by a pump and dump scheme, which by the way would be totally illegal if you did this in the stock market. And this got me to thinking, because a lot of you guys out there in my audience have sent me messages thanking me for talking about credit cards and credit improvement and all of that in a previous video, and even people who say that they don't like my channel, don't like my political views, don't like my content, have thanked me for improving their credit with the tips in that video. So I think I want to do the same thing in terms of investing, so that you guys can understand that the real way to grow wealth through the stock market or through investing is slow, boring investing, not these get-rich-quick schemes. So I'm going to tell you what I do, how I allocate my money, and why I do that, but I have to give the caveat, because everybody seems to have to give the caveat, that I'm not a financial advisor, and this is not financial advice, but this is what I do with my money, what I recommend personally that you guys should look into, and I'm going to explain it to you in a very simple, very concise way, because many of you out there have no idea how much money you're leaving on the table by not investing in very simple, very basic index funds that are very low cost in order to do so. So we're going to get into this. We're going to talk about this. By the way, there will be no affiliate links or any kind of sponsorship throughout the course of this video. This is just free, me discussing this with you to hopefully improve your lives. But before we get into that, I want to thank everybody who supports this channel via actualjusticewarrior.com/join.
Give me the money. Give me the money. Okay?
Now look, obviously, after I gave you that pitch about free, basic, not get-rich-quick scheme kind of investing, I gotta tell you about my own crypto coin, which is called AJW Pump Then Dub Coin, where you guys put in all your money and pump up the stock, and then I take all that money out of the crypto, pocket it, and disappear to Aruba. No, I'm just kidding. I'm just joking about this. What we're actually gonna talk about is a couple of different types of accounts, which include IRAs, the traditional, Roth IRAs, my preference, which I will explain why, and of course your standard ordinary brokerage account. And for those of you who are unaware, an IRA is called an individual retirement account, and in the traditional IRA you actually get some tax advantages in the immediate, in that you are allowed to put your pre-tax income into that account and in order to invest with that account. However, my preference is the Roth IRA, where you put your post-tax income, so you pay the taxes up front, and then all of your returns over time are tax-free, provided, of course, that you take out the money after retirement age. And I want to explain why this is so advantageous with a standard, basic, easy-to-understand investment calculator that factors in a normal rate of return for investing in the market. And by the way, I'm going to tell you which funds I specifically have my own money in, and I will show you the returns that I got in the previous year, so you can understand I'm not trying to sell you down the river or give you vagaries that you're not able to duplicate on your own if you were to choose to do so. But again, let me explain to you why I like the Roth IRA over the traditional IRA. So if you go to a standard investment calculator and you say that you're going to put in $100 to start, $100 a month, and you factor in a standard return for an S&P 500 index fund or for a total market index fund of around 10%, then over the course, if you start at age 20 of 45 years, you will earn over $900,000 in that particular account. But more importantly is the breakdown of that $900K, because the principal, what you actually put in over the course of 45 years, is $54,100. However, the interest that you will have earned is $854,000 over that, by the way. So the reason I prefer the Roth IRA in terms of a retirement account over the traditional IRA is because if you did the traditional IRA, you would be paying the taxes on what you take out at the end of the cycle. However, with the Roth, you only pay the taxes on what you put in up front. And in this case, that's $54,000 versus, again, the total of $900,000. Obviously, this is very advantageous for you. However, what you guys also need to understand is that the maximum contribution limit for any type of IRA is $7,000 right now. Although, to be clear, when you get above a certain age, it jumps up to like $7,500. And of course, it is subject to change because when I first started investing, it was actually $6,000. So let's say you actually put in that maximum. You actually are able to put in $7,000 a year for the whole 45 years from age 20 all the way to age 65. What would you end up with? So we'll start with $7,000, and then again, we have 45 years of growth. We have 10% rate of return, which is a standard average return for certain index funds. We do an annual contribution amount of $7,000. Your total put in terms of principal is going to be $322,000, but your total interest, which is your return, which by the way, you're going to be reinvesting so that that can gain interest itself, will be $5.22 million for a grand total of, again, $5.542 million. And again, that $5.2 million is going to be tax-free because in a Roth IRA, you already paid the taxes on the $320,000 that you put in. Again, this is the way to make money through investing. Slow, long-term investments that compound over time that ultimately set you up by the time that you retire or by whatever end date and goal date for success. This is how I personally invest my own money, and it's not a get-rich-quick scheme or anything of the sort. And I understand a lot of people are going to say they're not able to put in $7,000 into a Roth IRA over time. But remember, I showed you the difference of 100 and then the maximum. You can put in anywhere in between those amounts, again, in order to make your returns, and you will have varying results. Again, with just $100 a month, for that period of time, you were able to make, if you followed that plan, and again got an average return of 10%, which is honestly the average, but it's kind of low in the American stock market, but you still made $850,000 based on, again, $100 a month. If you're spending more than $3 on coffee a day, you have $100 a month in order to invest in an account in order to make that money. You're throwing that away because you see what it can turn into, and this is the way that I want you to think about investing. Now, let's say you guys are more disciplined. You're actually able to fill your Roth IRA each and every year to the maximum, and you want to put more money into investments in order to make yourself more successful, but obviously you've reached your individual IRA cap. Now, of course, if you work a regular ordinary job and you have a pension offer from your job, then you could increase the amount that you put into your pension that way. Also, a bunch of those pensions offer Roth versions of the pension, so that's something to look into, to talk to with your HR department, to talk to with your finance department. And again, I would still recommend you structure your investments in the same way that I'm recommending. However, if you want to go even beyond that, you can open what is called a regular individual brokerage account, and oftentimes the same companies, Fidelity, Schwab, whatever, are the ones that offer these accounts of both kinds. Now, when I got into this, I was really into this, so I chucked a bunch of my savings into my IRA, ended up funding it for more than a year. So I ended up opening a brokerage account myself, and now I contribute a set amount each and every month in order to try to make sure I hit my goals for retirement and my overall financial goals. But the thing is, it's one thing for me to tell you to invest in the S&P 500, invest in a total market fund or something like that. But I should probably, give you guys the funds that I would recommend recommend doing so. And by the way, I also should show you what my returns are on my brokerage account, on my Roth IRA, so you can understand that this actually can work. And by the way, if you would have done this in the previous year, you would have had a great year financially. So this is currently my 1-year return investing with the strategy that I'm trying to recommend to you. As you can see, I am at plus 23% for just 1 year. Remember the investment calculator? I was calculating a very conservative 10% a year, and the S&P 500 is up 28%. Now, the reason my returns are actually underperforming both of those funds is because I'm invested in one additional fund beyond an S&P 500 and beyond a total market fund, and that is a fund for international stocks, and that one is underperforming the other ones. It's at about 6%. However, I have a smaller portion of my portfolio in that, and the reason I have that is because traditionally the US stock market greatly outperforms the international stock market, but that may not always be the case. So this is my hedge against maybe the international market eventually surpassing the US market over the course of that long time horizon. But again, my growth for 1 year on the money that I put in was 23%. 23%, people. Again, almost a quarter of a return on these basic, simple investments in just 1 year. Now, the question you might have is, Sean, okay, I believe you. I'm on board. I've bought into this. How do I actually start investing? What's the best way possible? And in my opinion, and by the way, when I first started, I was not smart enough to do this myself. I actually chose Charles Schwab. I would open up both the Roth IRA and the individual brokerage account if you were choosing to do so with Fidelity. And the reason why is because the Fidelity Total Market Index Fund actually has zero fee for managing it, because a bunch of these different funds have their own fees. And by the way, their S&P 500 index fund, which I also split my investment in, has one of the lowest fees, if not the lowest fees, for any S&P 500 index fund. But it's really important for you to understand that you don't necessarily have to invest in the Fidelity one or in the Schwab one or in the Vanguard one. You can find one that fits what you're asking for. Just look up their track record and compare the funds, and remember to think about the fees that are associated with it, because Vanguard is basically the industry standard in terms of these index funds. They're going to have higher management fees, which may not seem like a lot, but that will cut into your overall profit because that is a percentage of what they take. Fidelity is the new kid on the block, so they have the lowest fees, but when you compare their funds side by side, they tend to perform very well in comparison. So here is exactly what I would recommend. And again, I'm giving you the exact mirror of my not complicated investment strategy, which is, by the way, a diversified investment strategy because you're investing in index funds, which are collections of stocks, not individual stocks. But this is what I would do. So write it down, pause the video if you need. I'll give you the name of specific funds, whatever you want, but I would put 40% of my portfolio in an S&P 500 index fund. Now, the Fidelity one is called FXIAX, which is FXAIX. The Schwab one is called SWPPX, and of course Vanguard has one, and a bunch of other ones have it, but the Schwab one is the second cheapest, and the Fidelity one is the third cheapest in terms of what it costs them to manage this specific fund. Now, next on my list, I would put 40% of my money into a total market index fund. Now, the Fidelity one is called FZROX, which is FZROX, and the Schwab one is called SWTSX. Again, you can do either one. They perform about the same over time. Also, Vanguard has one. Also, many brokerage options have one. But the reason I recommend the Fidelity one is because the Fidelity one actually has a zero fee for this specific fund. And again, both of these funds just try to track the total stock market, like the S&P 500 fund tries to track the total of the S&P 500. So that's what you're trying to get. Market goes up over time, you make money over time. Again, boring investment strategy. Now, the third one, where I put 20% of what I invest, is the International Market Fund. Now, the Fidelity one is called FZILX, which is FZILX, and the Schwab one is called SWISX, which is SWISX. Now, again, this tries to track the total market returns for the international markets, and again, even though the US stock market over time, over history, has outperformed those markets, that may not always be true, which is why I designate a certain amount of my portfolio to the international market. But honestly, I could do a 45 between the index and the total market fund and 10% to the international, because right now the returns are not as obvious. This is kind of a hedge. And one of the things that I would recommend if you're investing in any type of way is that if you want to jerk around and do individual stocks or whatever, that should not exceed more than 10% of your portfolio. And based on this investing strategy, you should take that 10% out of the 20%. So 10 to the international fund and then 20 if you want to jerk around, if you absolutely feel it's necessary to do so. And that should only be what you're doing all the crazy stuff with that I definitely don't recommend. But over time, if you follow this strategy, you will be successful in investing. And the best thing about it is that it's a set it and forget it kind of thing. Both Schwab and Fidelity have easy to do online accounts where you could set automatic monthly, weekly, yearly contributions to go from your account to there. You can automatically invest it. And guess what? When you get dividends, you can automatically reinvest those dividends. So again, it doesn't matter to me which one you end up choosing. I recommend Fidelity because they're the new kid on the block, and I wish I would have started with Fidelity. But Schwab is a bit older, and again, they're cheaper than Vanguard in terms of management costs, typically, because there are funds that are available through both platforms that of course will cost more. But if you go with the ones that I listed out, which I will write out in the description of this video, you should be perfectly fine over time. Now again, it is really important that you understand what I mean by over time, because that is absolutely key. Because when I initially first started investing, when I first started buying into the stock market actually plummeted right after I put my money in. So it gave me the feeling like I lost money. Now, to be clear, the reason why I say it was the feeling like I lost money and not me actually losing money is because I didn't sell any of my positions because I am investing for the long term. In reality, when the market dipped, because I held on these under the idea that I have a long time horizon and that yes, I was trying to make money, but make money over time, I ended up buying stocks at a discount because again, over time, it's going to go up. Sure, there's going to be fluctuations from year to year, but give it 5 years, give it 10 years, give it 20 years, and you will see the trend of the stock market is usually always up. Again, unless you believe that there is something apocalyptic that is going to destroy the United States economy, the world's strongest economy, all of a sudden, this is a solid strategy. Of course, always the caveat anytime that there's risk with investments, but this is a diversified strategy, not individual stocks. I'm not telling you to put all your eggs in one basket. In fact, I'm telling you just the opposite. All of these funds are diversified funds that are groups of stocks meant to track what has been long-term, proven solid investments. Now, if you're trying to get rich quick, if you're trying to scam crypto or whatever, this isn't the video for you, but this is a basic tip, a basic advice for investing. And if you're a young person, I really recommend that you at least throw $100 a month like I showed you earlier. Increase it when you get older because time is on your side when you're compounding interest. So yeah, starting early is great. If you can start yesterday, you should have started yesterday, but the second best time to start is today. I really hope this video helps you guys. As usual, if you like this video, show them by leaving a like, subscribe for more content, follow me on my social medias, support me via the support links in the description of this video. This has been me giving you basic, simple investment, not advice, because that would be illegal, I guess. Till next time.